Well, I'm excited to have Elizabeth Edwards, the founder and general partner of H Venture Partners, with us. How you doing, Elizabeth?
Great. How are you?
I'm doing well. And you are, where are you sitting today in the country?
Today I am in the consumer capital of the world, Cincinnati, Ohio, right down the street from Procter and Gamble and Kroger.
I guess you could make that claim. That's a legitimate
Yeah,
claim. The consumer goods capital of the world. I'll
we
let you have
are.
that. I'll let you have that. I want to talk to you because I think, investing in consumer brands, it's a particularly interesting time right now. We're seeing a lot of consumer behavior change.
hmm
And we've just seen, I think, over the past 5 years, really almost a revolution in things like direct to consumer and just the way in which brands are approaching consumers. So I think it's a really interesting space you're in right now.
It is. It's a space that I've been investing in exclusively over the past 7 years. So I've been a VC now for 15 years. It's interesting because my first deal back in 2005 was actually a food technology deal. But then, like all VCs kind of got roped into software as a service and healthcare companies. And so learned a lot about the business of investing. But it was actually 7 years ago that I really started to focus on consumer. And it is a really interesting time to be a consumer investor.
And a lot of investors purposefully avoid consumer because it's a hits driven business.
hmm
You need to have Pelotons, which we'll talk about to
Right.
kind of, you need those types of things in your portfolio.
hmm
And it's really dependent upon developing that brand, which involves a lot different dynamics than say
hmm
building a B2B SaaS software company.
Yeah, I think that like anything, you really need to invest in what you know. And I think there are a lot of myths out there about consumer, the least of which is, oh, consumer is not scalable. And to the naysayers, I say, ever since the Industrial Revolution, consumer's been pretty scalable. P&G makes 20,000 diapers a minute. Don't get much more scalable than that. But it is, as you say, something that historically the institutional investing community has viewed as a hits-driven business. But when you actually look at the standard deviation of outcomes in consumer relative to tech, what you find is it's actually a better risk-adjusted return. So when you compare consumer venture to the broader venture asset class, which includes things like biotech, and if you want to think of a hits-driven business,
Yeah.
look no further than biotech, where you've got a long time before you ever see a dollar of revenue. And there are binary steps along the way. Is this clinically effective? Is it safe? Is it clinically effective? Is it something that we can get reimbursement for, right? And so there are just so many different gates that you have to go through in order to get a biotech product to market versus consumer, where generally, the barriers to entry in consumer are a lot lower. You can get products out the door a lot faster out there in the marketplace and start testing and learning. The issue has been that we've seen a lot of VCs that are not consumer folks actively investing in the space, not really knowing what questions to ask. Because, when you look at, all right, consumer compared to the venture asset class, consumer venture actually has outperformed the venture asset class by about 7%. But the outcomes look a little bit different than in tech and biotech. So in tech and biotech, the universe of strategic acquirers isn't as broad as it is in consumer. We think of like Coca-Cola, Nestle,
Right.
Pepsi, Kellogg, Estée Lauder, L'Oreal, Unilever, P&G. You have so many different strategic acquirers that are looking at these brands. And typically the brands are traded for about, plus or minus $200 million. So they're acquired fairly early, and the things that strategic acquirers are looking for are pretty specific. So I think it's a misunderstood sector. from the outside, it may seem like it's more of an art than a science. It is a science. It's a very data-driven business. When I talk about, Cincinnati being the consumer capital of the world, yes, we have the world's largest consumer products company headquartered here. Yes, we have the largest grocer headquartered here, but what we also have is a ton of data. So there are all of these data providers that surround those companies and really focus on consumer insights.
So let's talk about how data has changed the game. I mean, I would imagine that, 20 years ago, if you were to develop like a new consumer packaged good food product, it's a lot of word of mouth. You get into Whole Foods, maybe you move up the chain, you're in Kroger, eventually it's successful, but like it's a lot of more probably relationship based. It's like the old kind of baseball, traditional world before Moneyball, and not a lot of data driven insights. How are data driven insights helping prospective entrepreneurs who want to get an exit get there?
Yeah. So when we look at, like I said, barriers to entry have really fallen away. I mean, you can get anything manufactured, you can put it out there direct to consumer. That's been a great testing ground to really see, anything from beauty products to hair care, food. And so what entrepreneurs in the consumer space are able to do today that they weren't able to do before is walk into a retailer like a Whole Foods with data that they never had before.
Right.
So, one of the key things that I look at when I look at new opportunities, and I really look at a broad set of opportunities, there are about 30,000 brands within our target space. So tangible consumer goods, seed through early growth equity, kind of 0 to 50 million in revenue. And we look category by category. And almost universally, these brands are on Shopify. They can download cohort data, and we can look at the patterns within their existing customer base. So we're seeing not only, sales are going up, great, but we're also seeing key things like repeat purchases. And repeat purchases tells you a lot more about how consumers feel about the product. There's your marketing, how effective you are at getting your message out, but then there's how much people love your brand and your product and how loyal they are to you. And so if you're walking into a Whole Foods saying, hey, we've got this great brand, we have, 10,000 followers on Instagram, they're highly engaged, we've got a 40% repeat purchase rate, people just absolutely love our stuff. That's powerful data for a retailer to take and go, oh, great, like this totally fits in, and they can take that risk with a lot more confidence. And it's the same thing for strategic acquirers, right? Because they're also looking for some of the same things that those retailers are.
You mentioned Shopify. I've followed that platform pretty closely, and I think that they've been a huge strategic platform for D2C. Can you talk about what you see there? I mean, they feel like they create a counterbalance alternative to Amazon. If you want to go online, you can actually keep your own brand and own it. And now that they're even creating the Shopify branded app, it allows another channel for D2C consumer or products to go to. Can you talk about how Shopify has helped some of the brands in your portfolio?
Yeah, I mean, in the olden days, when you would hire a web developer and just pay out the nose to put together a website, that's another barrier to entry, right? That Shopify just took off the table. I think what they've done, what they and Amazon, I think correctly, is both, big in the e-commerce business. They're really focusing on making that purchase frictionless. And so I don't know about you, but, the thing that I hate the most is when I arrive on a site and I know what I want to buy because I saw a beautiful ad on Instagram or on Facebook, and it's like 10 minutes to check out. Part of the beauty of e-commerce is that it should be convenient. And what Shopify has done is they've really pulled in all of that great, UX design, but also frictionless payment to say, just PayPal it. or whatever your preferred method of payment is. So that's really strong. And then for brands, what they've built is a back end that it's not just a transactional platform where, okay, great, I'm able to, drop ship. You're also, you have data about your customers, about their behaviors and their preferences. And that's really powerful, right? Because that really allows brands to do what they need to do, which is, upsell to their existing customers, say, hey, you like this, you'll love this. And that's something that if you had to build that from scratch, it'd be really expensive.
So when you're evaluating consumer brands, what are some of the intangibles that you're looking for, and some of the characteristics you're looking for that may not always jump off the page in terms of data, et cetera? So what are some of the things? Is it founding team? Is it the defensibility of the idea? Yep. Talk about that.
Yeah. So we've talked to, at this point, in my career, I've probably had over 10,000 pitches. So I've heard a lot of pitches over 15 years. But the way that we've really organized ourselves on the investment side, we have a triage form, which is basically, and these are terrible notes. This form that we use, the triage form, is really meant to keep us focused because talking to so many companies, we need it to be a 30-minute conversation. At the end of the conversation, we know if we want to have another conversation or not. And we do a lot of work to kind of chop through all of these 30,000 brands so that we're not even bothering the brands that we already know wouldn't fit our criteria. So we're just really focusing on the ones that are higher likelihood. So if you get a call from us or an email from us, it's because you've already checked a lot of boxes. And then that's about half of our deal flow is active outreach. But the two biggest things on our scorecard are management team and the brand and how it's differentiated in the marketplace. And that drives a pretty substantial chunk of the score. So it's a weighted scorecard. We're looking at broadly 10 different factors, and those two are the most important. Of course, we're looking for things like capital efficiency, right? Because especially in our space, think about it. If you are not a Peloton, if you're not going the IPO route, you have to be really, really careful about how much money you raise relative to your revenue, and be really, and even the folks on the IPO pathway have to do this, but typically they're raising a lot more capital in order to be a much bigger concern by the time they're going public. Firms that are acquired for 200 million, might have 20, 50 million in revenue at that point. So hopefully they've been, really, really lean. And so when we think about management teams, we're looking for management teams with domain expertise, channel expertise, previous exits, they've worked together before. Very rarely do we see a management team that has all of those things. So work together before, a lot of times, that's not something that people have. But domain expertise and channel expertise are pretty important. So for instance, if you have, a skincare brand that you're launching, hopefully one of you has come from skincare or beauty. And maybe the other, if you're launching direct to consumer, hopefully one of you has at least had some experience with that channel before, because it's a different muscle to flex. So we look for those things. And then a lot of intangibles on the brand that are really focused on consumer insight.
How many of those that you view at the top of the funnel make it past that 30-minute review process that you actually, what's the kind of...
Yeah. Well, right now we have 6 portfolio companies, and we've talked to over 1,000 companies in order to get those 6. So that kind of gives you an idea of the...
So less than 1% you guys actually invest in. But I would imagine of those 1,000, some get to a second stage, some get to a third stage.
And a lot of times, I would say most of the time, we'll talk to a company that our first conversation is a no, but it's not a total no. It's a not yet, because there are certain risks that we are willing to take on, and there are certain risks that we're not willing to take on. So, for instance, you may have half of a great founding team. You may have a product that you have completely formulated but not launched yet. Or in the case of like a Peloton, you might have a manufacturing prototype that you haven't launched yet. What we don't like to take on is things like R&D risk, right? Where you've got a big vision for what you're going to do, but you don't have a manufacturing prototype or a formulation, or you don't have the kinks worked out. There's still some pretty big technical barriers to actually deliver what you're trying to do. And there are others, but those are some of the main ones.
So you guys have invested in a couple of food companies. When you're looking at food, are you looking at a new take on a category? Are you looking at new, broader themes that fit within kind of like what's becoming a bigger overall trend within consumer eating habits, like plant-based? What are some of the things you're looking for when you're going to invest in a food brand?
Yeah. So, food is probably my favorite category. We spend more on food than anything else. I think it's the most important thing to invest in. It affects so many people. And that's why, organizations like yours are so important. When I think about investing in food, that category it's just, number one, it's massive. And there are so many different needs and tastes and desires, but there are undeniable trends, some that have existed for over 50 years, like the natural and organic trend. Those are trends that are here to stay. So we definitely start with consumer trends. And so things that are more plant-based, absolutely. But then within food, we're breaking it down into subcategories and looking at, because we're really thesis-based investors, we're looking at what's missing within certain categories. I'll give you an example. The frozen food section right now is just a real head scratcher to me, because if you look at mass and major grocers, what you find is like the aisle is dominated by frozen pizza and ice cream with very little differentiation between brands. I mean, like, how many different brands of cookies and cream do you really need? Yeah. And meanwhile, if you look at,
although some of the new ice cream is good, you do have some plant-based ice cream that's not bad. So, and
we spent a lot of time looking at that. We're very excited about, So a lot of plant-based ice cream in the pipeline, and so really excited about those. But yeah, and that's a really great example. Same thing, cauliflower crust. Who would have thunk? Absolutely great. So what I'm looking for, though, in that aisle, because it's such an opportunity, and it's such a tough aisle, I'm looking for that aisle to reflect the tastes of folks that are, going out at restaurants today. When you look at the breadth of the choices that you have when you sit down at a nice foodie restaurant, and then you walk down the frozen food aisle, you go, it's interesting that I'm not seeing more of the obvious trends, out there in food being infused in frozen food. And you just
it does seem like frozen's starting to have a moment. So there are some people who are starting to think about it. Millennials are starting to think about it more, but you're right. It's largely been kind of stayed and kind of moribund.
Well, and it's also something that I think is going to benefit from COVID. It already has.
Right.
You have more people eating at home and cooking at home today than ever before, and that's just a massive opportunity for prepared meals and things that are again on trend. What's to love about frozen? Lack of preservatives, freshness. There are lots of challenges as well, but I think there's a lot of opportunity there.
So COVID, you brought it up. That's a good to ask about. I mean, we've seen the data, and you have as well. Obviously, a lot of people are cooking at home. Some of it will snap back as people head back to restaurants and restrictions lift. But I do think there might be some fairly long-lasting behavior changes. So what are the impacts been? What are your thoughts around your investment theses? Have there been any changes and things that you're looking at post-COVID?
Yeah. So, what we actually just hosted a webinar where we thought, well, we give all of this great information to our portfolio companies and our investors on consumer trends. And this is such a disruptive time. We should, share some of this data out. So we look at things like where people are physically, where they're spending their time digitally, what they're buying, of course. And what we found is an acceleration of a lot of trends that were already happening, right? I mean, quite obvious, grocery delivery is really having a heyday, which is great. Certain retailers are really benefiting, the essential retailers like grocery, like mass. But in general, some of the surprising shifts, because we also cover like home care. For the longest time in home care, we were thinking, we're seeing companies, brands like Method and Miss Myers, who are both SC Johnson brands, really lead in seventh generation, really lead this overall trend where you're using natural essential oils and plant-based materials for household cleaning. And then there was a sharp reversal where you could not find a bottle of Clorox anywhere because people were looking for sterilization.
They wanted poison to kill stuff.
Right. And then we saw an acceleration for functional based foods with benefits like immunity, but then a reversal when it came to health food. Like suddenly, we're all sitting at home, cooking at home, eating at home, and we saw a sharp rise in comfort foods, which I think for this time is absolutely to be expected. Sales of things like Oreos and Goldfish crackers and Campbell's soup, which was not necessarily on an upward trend. We saw that. But I think that, in the beauty space, we're seeing a lot more attention to health and self-care, and a reversal. We already saw that, cosmetics were lagging when it behind skincare. So fewer color cosmetics, more natural, dewy type skincare. I think that overall self-care movement, once we settle down more from the trauma of the shift to facing what is our new reality, because we're already starting to see, health is becoming, more and more a theme. People do have a little bit more time, or they've been given some time back from, morning and evening commutes. I do think that we're going to see that, come back. You can't stand comfort food forever. Yeah. People are, they're putting on the pounds, they're seeing it. So I think it's an interesting opportunity for new brands, and especially brands that can deliver on some of those more restaurant-like experiences at home.
Yeah, I totally agree. I think we're already starting to see a snap back a little bit in terms of the huge carb consumption. People are getting outside. They want to look good. I want to ask you about, in the tech world, we talk a lot about platforms. Mm-hmm. It's almost a cliche, but when you talk about consumer brands, do you have that platform-like thinking in terms of when you're trying to find a consumer brand?
Yes.
Obviously food, like you can invest in ingredients that oftentimes are treated more like a platform play. But what about the actual consumer brand products?
Absolutely. So, so great that you bring that up, because it's actually the number one thing on our litmus test. So, you won't get a call from us if we don't see the potential for $1,000 lifetime revenue value of a customer. And in food, you get there pretty quick. In addition to Peloton, I also invested in a lot of food companies in my previous firm. Freshly is one. It does not take very much time to get to $1,000 lifetime revenue value of a customer, because food tends to be a higher frequency, item, as opposed to like mascara, right? You're not buying it every week. You're buying it once a quarter. So with food, though, we're not looking for a single SKU. We're looking truly for a platform where you've defined your brand in a way that you've given yourself permission to show up, to either dominate an entire aisle or to show up in multiple aisles. And I think, I can think of a lot of different brands that have done this and done it well. If you think of, I'll give you an example from cleaning and personal care. The Honest Company. Honest Company. Whoa, talk about platform. You could argue that they went too far, too fast, but they're literally in almost every single category. Laundry, baby, beauty, and so that that is a platform brand.
Is it akin to what you might call a flagship brand or an anchor brand? So like an RX bar, right? So if you the RX bar, you have that packaging that we're all super familiar with. They have that look and feel with ingredients on the front. They're now diversifying into like kids versions, et cetera. But you have that anchor brand, the first one you bought. Is that kind of, when you think of platform, you're talking more like that flagship anchor brand?
Absolutely. So I think this really goes back to how you're defining your benefits. And a lot of times we have the temptation is to be cute with a brand instead of being really focused on what is the benefit that I am ultimately, what's the promise, the brand promise that I'm delivering to my customer. I'm thinking of a brand right now, Lesser Evil, in the snack aisle. Very innovative brand. Lesser Evil, they've given themselves permission to sell all kinds of different healthy snacks within there. But if you look at, if you contrast that with other brands that may have said, we're chips, right? It's going to be hard to move from chips to sauces.
We're in a kind of interesting moment, just generally in the U.S. We've watched the last 2 or 3 weeks where there's just been a huge uprising and people kind of speaking out against systemic injustice and racism. In tech, there's historically been a way underrepresented community. The Black community has been traditionally way underrepresented, and I'm curious to think and talk to you about the way that is in consumer brand investing. Is this something that you are looking to potentially address as your own company? And is this something that, is a problem as well in consumer brands?
It's just a universal problem, period. And one that, I think we've been talking about for a long time in a variety of different ways. Just to give you an idea, and this is a problem that is not helped by the investment community. So it is shocking to many people when I give this statistic, but if you look at your portfolio, so you're in stocks and bonds and you've got a wealth manager and they've got a retirement plan for you, and they're helping you figure out how much money to sock away for your kids' education. That wealth manager is investing in funds. And they might be index funds, mutual funds, hedge funds, venture capital funds, private equity funds, real estate. Those funds, when you think of the $70 trillion of assets under management in the U.S., less than 1% of those funds are managed by women or people of color.
Less than 1%? That's crazy.
Less than 1%. And so what that does, and our principal, Sasha, wrote a great blog post about this. It's on Medium. So if you go to our blog at H.Ventures and click on blog, you'll see some of the blogs that we've written about this. But the investment community, because it is so white and so male, it's not surprising that, that hair care brands for women with textured hair, so African-American hair, curly hair, it's not surprising that those brands do not get funded. I've literally had, and we are invested in one of those brands, along with a great roster of Black VCs and angel investors. And, I've had conversations with other investors about the deal, and I go, oh, there's no way that Black women spend 8 times more on their hair than white women do. And I'm thinking, like, I have a ton of Black friends. I know they do a lot to their hair. It is not an easy process. And it's, I totally believe that, because I know how much I spend on my hair. We were talking earlier, you're going to get a haircut. I spend $250 minimum, sometimes $300 every, 6 weeks on my hair. I don't know what you spend on your hair, but I doubt it's that much, right? So there are certain experiences. And when I talk about experience, because it goes back to the scorecard, management team, domain expertise, channel expertise, previous exits. VCs are judged on the same things. From an institutional investor's perspective, what Main Street investors have failed to recognize is that while we're working every day and, we're out there protesting, racial injustice, we're spending our time on environmental causes. Meanwhile, our money is not working for those causes. So you spend all day long volunteering for the things that you do, doing the work that you do at your job, promoting the issues that matter to you. And maybe you're really active, with women's issues at your company or diversity at your company. But then when you look at your portfolio, your values and your money are not doing the same thing. And so I think that has been a really big, stumbling block for, both for women who only get 2% of venture dollars, for Black entrepreneurs who get much less. And what people don't realize is it's not only that it's, that your values are not reflected in your investments, it's also that there's a huge blind spot there. Because as you and I know, if you're going to go and invest in, I don't care what the category is, but as food is different all over the world. We have a huge and growing Latin community within North America, and they represent a really attractive base of consumers to, start a relationship with, to build a relationship, build brands with. If you're not in tune with that community, you're going to miss out on those brands. And that's, that's too bad. I look at, and this is, by the way, been like the story forever. But if you look at folks that have built incredible wealth, look no further than, Madam C.J. Walker, who was the first Black millionaire. And she had a personal care brand focused on Black women. Or if you think about it another way, imagine a world where Beats by Dre, which is a Black founder, or Stitch Fix, or The Real Real, or Daily Harvest, all female founders, don't get funded.
Yeah, there's obviously blind spots because we don't have that just lived understanding, but there's just like a brand misunderstanding and blind spots. It's smart business to find these undiscovered brands, people who have true understanding of the communities that will ultimately consume it because they're from there, they're making great food. I do want to ask you about CPG investing versus just traditional hardware and
Yeah.
technology products. If you look at if I look at all the brands on the aisle, and I love walking down, like, for example, the drink aisle and just seeing like 1,000 different kinds of cans. It's for like a food nerd like me, it's exciting. How many of these have investors versus just like that was something that was self-funded by a person with an idea? They bootstrapped it. Obviously, when you look at the tech worlds, almost every one of those ultimately have some level of investors. Is it much different in the CPG and consumer products world?
For the big brands, if they've gotten to any, relevant size, or they're a pretty well-known brand, they've got investors. I think, like we were talking about earlier, because of, the just erosion of the barriers to entry within the consumer space with contract manufacturing, with direct-to-consumer, that better data, and also just a cultural shift, right? Retailers have really focused recently on being a trusted curator of brands to really support, new and emerging brands, because they're realizing that they're growing the category, right? And so access, to those retailers. But consumer has been traditionally the land of angels. So you can build a pretty good business. There's some startup capital required, right? To meet your minimum order quantities, to really get that brand, and the formulation up and running. You're gonna need some capital. I have seen lots of different estimates out there in terms of what it takes to launch a brand, and in general, people say plus or minus, it takes at least $1 million. It takes at least 12 months to do it properly. And the cases where we're involved, it's more than that. It's more than than $1 million round. Typically, these are $2 million rounds that then become $4 million rounds the next time, 12 to 18 months later. And those are the brands that are, kind of growing, 5X in 12 months, because they have the fuel. Otherwise, it's really hard to do that organically. You got to be really lucky. You got to be really lucky with payment terms, your cash conversion cycle. And it's hard to get working capital lines.
Is it partly because existing incumbents with lots of cash, with manufacturing wherewithal, will see a fast grower, see shelf space being ceded to them, and they'll copycat, or like as a fast follower? I mean, is that why you need to basically have an investor to kind of fight against the incumbents, or have the incumbent ultimately buy you?
You need to have investors in order to get to any appreciable size with momentum. And it's just, unless you are, personally really well funded, right? If you've got $4 million to fuel your own company, great.
And that's a lot of second time founders can do that, right? So
exactly. Yep. It's, sort of the, you too can be a CPG founder, and grow your business to 20 million top line and sell it. I think that, there are rare cases where, and I saw this more back in like 2014, than now. And so to take you back a little bit, in January 2014. January 2014, I was at Maywick Select Investments doing the first deal out of that portfolio, and that was Peloton. And at the time, when you looked at the cost of D2C ads then versus now, the cost has gone up about 100% a year. And so if Peloton launched today, I don't think that Facebook would be an effective advertising platform for them to launch, because it would be so expensive in order to acquire that customer that they wouldn't, have enough, contribution margin to go and do it again. But I saw a lot of brands, in that like sort of 2013, 2014, 2015, launched during a time when advertising was cheap benefited from it, grew a business, exited. They were extremely capital efficient. Harder to do now.
Yeah, you need to, I mean, the data probably helps, right? You can maybe search out those like leveraged and arbitrage opportunities. There's a little bit of like an advertising arbitrage opportunity with Facebook in that time frame. So maybe now it's TikTok or whatever, but you got to find those like cost per impression, bang for buck opportunities that can help launch you and get you that fuel.
Absolutely. Absolutely. Yeah. So, we saw that with, kind of wave after wave. There was a Pinterest wave, right? That for certain categories was really helpful, food and home. And now I think we're onto the TikTok wave.
Well, my kids will have to help me with that because I'm definitely not advertising on TikTok. But hey, Elizabeth, thank you so much for spending time and sharing some of your knowledge. You've been in the space for a while, and it is an interesting and difficult space to invest in if you don't know what you're doing. So we really appreciate you telling us a little bit of how to do it.
Thank you so much for having me.